Hi, welcome to today's video. Today's video will be on depreciation, and we're going to look at some of the general aspects of depreciation, and then we'll have some more videos on the more specific aspects of depreciation. So I call this video, by the way, Depreciation General. So, what is depreciable? Fixed assets other than land. Land is always assumed to be there and therefore is not depreciable. Why depreciate is to measure a loss of usefulness of a fixed asset to the user. It is not a method of valuation. We're trying to see how much more service the user, be the business, can get out of a particular asset in the future. So depreciation is not a means of valuation. So when we say the book value of a fixed asset is, say, $20,000, its market value could be 30 or 40 or 100. It is not a means of valuation. New account that is created that you may not be used to is accumulated depreciation. This account is a contra asset account. What does that mean? It means as it goes up in value, which it will, accumulates every year, the value of the asset goes down. So let's look at a balance sheet presentation here over time. The numbers are assumed so that we can see how this accumulated depreciation account works. We always start off with our asset, auto in this case, at its historical cost. So we must always show the historical cost. If we don't do that, and we only show the book value, then it appears that the asset costs less than what it actually did. Again, to be conservative in accounting, we want to show the historical cost. Less the accumulated depreciation. As I mentioned, this is a contra asset. As it goes up, the value of the asset goes down. So when we first get the auto, we have no depreciation. So the book value, the future services to the owner of that auto, is $30,000. In other words, he still hasn't used it, so he should expect a full life. After 1 year, with the assumption of $5,000 a year in depreciation, the book value drops to $25,000. Again, he expects another 5 years of life in that auto, 25 divided by 5,000 a year. At the end of year 2, 30,000 minus 10, 5,000 from the first year plus 5,000 from the second year, gives it 20,000 in book value, again divided by 5 or 4 more years of life. At the end of 3 years, it's 30,000 minus 5 plus 5 plus 5. In other words, the accumulated depreciation gets bigger, it accumulates, and the book value falls to 15,000. Again, the book value is a measure of the future service of an asset to the user. At this point, I can expect 15,000 divided by 5,000, or 3 more years of service to that particular asset. The form of an adjusting journal entry is to debit depreciation expense and credit accumulated depreciation. Again, remember, book value is not market value. Book value, again, is not a measure of valuation. It's a measure of the future services of the asset to the end user. Book value equals to the cost of the asset minus the accumulated depreciation to date. So again, cost of the asset minus the accumulated depreciation to date is the book value. Now we will look in the next few videos at the different methods of depreciation. I will have a video for each one. And so if you have any questions, feel free to email me at the course website. Talk to you later. Look forward to seeing you on the next video.